Is there a shoebox that makes you nervous? Is there a drawer that makes you nervous? Is there a digital folder on your computer that makes you nervous? It's the one filled with crumpled receipts. It's the one filled with mystery bank charges. Many business owners have one. As the year ends, that box starts to feel heavier. The thought of sorting through it for tax time can bring a wave of stress. You might worry about missing important deductions. You might fear making a mistake that could cause problems later. This feeling is common, but it doesn't have to be your story this year. We are going to tame that chaos together, step by step. This guide is your friendly roadmap. It will lead you through the process of closing your books for the year. Think of it like a checklist you use before leaving your house for a long vacation. You lock the doors, you check the windows, you make sure everything is secure. Closing your books is just like that. It's about making sure your business's financial house is locked up, secure, and ready for the new year. It ensures nothing is left open to chance, and you can relax knowing everything is in its proper place. So, why is closing your books at the end of the year so important? It's not just about getting ready for taxes, it's about knowing the true health of your business. Clean books give you a clear picture of your performance. They tell you if you made a profit. They tell you if you made a loss. They show you where your money came from. They show you where your money went. Without that picture, you're driving your business with a foggy windshield. You can't make smart decisions about pricing. You can't make smart decisions about spending. You can't make smart decisions about growth. It is the foundation of good business management. Let's talk risks of not doing a proper year-end close. First, mismatched data. Numbers in your accounting software don't match your records. QuickBooks, 0. Bank statements, credit card statements. These simple errors cause huge headaches. You might record income twice or miss an expense completely. Small mistakes add up. They can make you pay more tax than you need to, or worse, not enough. An organized close helps you find and fix these errors early. Another big risk, missed deductions. That means claiming all allowed business expenses. When records are a mess, expenses get forgotten. Without review, those deductions are lost forever. That's like leaving money on the table. The very first step in your year-end close is called reconciliation. This sounds like a fancy word, but it's simple. It means you compare your business's bank accounts, credit card statements, and payment processor accounts like PayPal or Stripe to the records in your accounting software. The goal is to make sure the numbers match perfectly. Every single transaction in your bank account should also be in your accounting software. This confirms that your financial records are complete and accurate. It's like checking your grocery receipt to make sure you were charged for everything in your cart and only what was in your cart. Here is how you do it. Get your bank statement for December. Also, open your accounting software. Look at the ending balance on your bank statement. Then look at the ending balance for that same bank account in your software. Do they match? If they do, that is fantastic. If not, don't worry. Your job is to find the difference. Start by checking off each transaction one by one. Compare every deposit on the bank statement to the income recorded in your software. Compare every withdrawal to the expenses you have listed. This methodical process will help you spot any discrepancies. Let's look at a simple example. Bank statement ending balance, 5,200. Your accounting software balance, 5,250. There is a 50 difference. You find a withdrawal for a 50 dinner with a client that you forgot to record. You add the 50 expense to your books. Your new book balance is now 5,200. Now, your bank and your books match perfectly. This is the goal of reconciliation. Finding those missing pieces is the key to having accurate records. Okay, great. This means your tax filing will be smoother, faster, and less expensive. You'll start the new year on the right foot with financial clarity and confidence. We are going to break it all down. This is not about becoming a professional accountant overnight. It's about learning a few key habits that will save you time and money. We will use plain words and easy examples, no confusing jargon here. If we use a special term, we will explain it simply. Once your transactions are all in your software, the next step is to categorize them. This means giving every dollar of income and every dollar of expense a specific job title. For example, money coming in might be product sales or service fees. Money going out could be office supplies, marketing, rent, or software subscriptions. This process is crucial. It helps you understand exactly how you are making and spending your money. Without proper categories, your financial reports will be a meaningless jumble. It's like throwing all your clothes into one big pile instead of organizing them into drawers for shirts, pants, socks. Take your time with this step. Go through every single uncategorized transaction for the year. If you are unsure where something goes, think about its purpose. Did you buy a new computer? That is likely a fixed asset, not a simple office expense. Did you pay for a Facebook ad? That goes into advertising or marketing. Being consistent with your categories is very important. Always put the same type of expense in the same category. This makes your reports reliable and easy to compare. Watch out for common mistakes. One is having a large miscellaneous or uncategorized account. This is a red flag for accountants and tax authorities. Another mistake is mixing personal and business expenses. If you accidentally use a business card for a personal item, record it as an owner's draw or shareholder loan, not a business expense. Remember, IRS and CRA have rules about what you can and cannot claim. You can typically only deduct 50% of meal and entertainment expenses. A pie chart can help you see where money is going and where to cut back. Beyond your daily income and expenses, there are other important accounts to review. Let's start with payroll. If you have employees, your payroll records are extremely important. At year end, your payroll expense in the books must match wages on payroll tax forms. Form 941, US, PD7A, Canada. This is a critical check. Any difference will cause problems with the tax authorities. Next, look at any loans you have. Bank loans, lines of credit, loans from family and friends. Get the year-end loan statement from your lender. It shows the outstanding balance as of December 31st. Compare that to the loan balance on your balance sheet. They should match. Review the interest you paid during the year. Interest expense on your books should match the lender's interest reported. It's an important deduction. Make sure it's accurate. Sales tax is another key area to verify. If you collect sales tax, GST, HST, or state sales tax, you're holding that money for the government. Confirm the amount you collected. Confirm the amount you paid to the government. Confirm the amount you still owe. Look at the sales tax filings you submitted. Do the sales on those filings match your accounting software for the same periods? Fix issues now. It's easier than during an audit. These checks are a health checkup for your business obligations. Quick checklist. Confirm payroll totals match annual payroll reports. Confirm loan balances match official statements. And confirm interest expense matches lender statements. Confirm sales on tax returns match accounting records. Pro tip: always keep copies of all government forms you file, like payroll and sales tax returns. Now that you have cleaned up and categorized your data, it's time to run your key financial reports. The two most important ones are the profit and loss statement and the balance sheet. Don't let the names intimidate you. You will want to generate these reports for the full year. from January 1st to December 31st. Reading them is a powerful way to understand your business's story over the past 12 months. They help you spot trends, ask good questions, and check for any remaining errors. First, the profit and loss, also known as the P&L or income statement. It shows your income minus your expenses over a period of time. The result is your net profit or loss. Compare it to last year. Is your revenue higher or lower? Did any expense categories jump up unexpectedly? For example, if your repairs and maintenance costs tripled, you should investigate why. Look for anything that seems odd. A negative number in an income account is unusual and needs checking. Next is the balance sheet, a snapshot of your business's financial position on December 31st. It shows what you own, assets, what you owe, liabilities, and what's left for the owner, equity. Remember, assets mark liabilities plus equity. Look for old unpaid invoices from customers and old unpaid bills to vendors. These may need to be cleaned up. Check for negative balances where they shouldn't be, like a bank account. This review is your final quality control check. Are there odd balances, like a supply expense with a credit balance? That could be a miscategorized refund. Does the owner's draw seem unusually high? That might explain a cash flow problem. With your books clean and your reports reviewed, you are now in the home stretch. Create a dedicated folder on your computer or a physical folder. Label it Tax Season 2025 Ready. This will be the central place for everything your accountant needs. Start by exporting the main reports. A full year profit and loss and a balance sheet dated December 31st, 2025. It's also a great idea to export the general ledger or trial balance. Save them as PDFs in your folder. Next, gather supporting documents. Year-end bank and credit card statements, year-end loan statements, final payroll reports and annual payroll forms, and contractor info for 1099 forms, or T4A in Canada. Include major purchase agreements, business mileage logs, home office records like utilities and rent or mortgage interest, and any estimated tax payment confirmations. The more organized your package is, the fewer questions your accountant will have. This saves them time and saves you money. A well-organized package demonstrates that you are a responsible business owner who takes their finances seriously. You are so close to the finish line. The final step before you can officially close the books is to make any adjusting journal entries. This is a task that you will likely do with your accountant. These entries don't involve cash changing hands. They make sure your financial statements accurately reflect your financial position, the final polish for your tax return and next year's analysis. One common adjusting entry is for depreciation. If you bought a large asset this year, a computer, vehicle, or machinery, you don't expense the whole cost in 1 year. You spread the cost over the asset's useful life. Your accountant will calculate the right amount and make a journal entry. This is crucial for stating profit correctly and getting the right tax deduction. Another adjustment might be for prepaid expenses. Say you paid business insurance in June. As of December 31st, part is unused. An adjusting entry moves the unused portion from expense to an asset called prepaid expenses. That ensures you only expense what you used this year, making your profit and loss more accurate and matching expenses to the period incurred. After posting all adjustments, do one last review of your profit and loss and your balance sheet. Everything should now be perfect. Then use the Close Books feature in your accounting software. It locks your records for the year and prevents anyone from accidentally changing transactions in the closed period. This protects data integrity and ensures your tax numbers won't change later. Now you have a solid, trustworthy starting point for the new year. We have walked through the entire process, from taming the shoebox of receipts to locking your books for the year. With a clear plan, this doesn't have to be a stressful experience. It empowers you with knowledge and prepares you for a successful year ahead. This annual ritual sets the foundation for growth, smart decision-making, and financial peace of mind. You've done the work, and now you can relax. To make it even easier, here is a final simple checklist. Pin it to your wall or save it on your desktop. Use it every single year. 1. Reconcile everything. Match bank statements, credit card statements, and payment processor statements to your accounting software. Find and fix every difference. 2. Categorize all transactions. Review the whole year. Make sure each item is in the correct income or expense category. Keep your miscellaneous account empty. 3. Verify key balances. Payroll totals versus payroll forms, loan balances versus lender statements, and sales tax records. 4. Review financial reports, full year profit and loss and balance sheet. Look for anything unusual and compare to last year. 5. Gather tax documents. Create a tax-ready folder with financial reports, bank statements, loan statements, payroll forms, and other important documents. Closing your books like a pro doesn't mean being an accountant. It means being an informed business owner. The cleaner your books, the smoother your tax season, and the stronger your business decisions for the year ahead. Ready to make this your most organized year-end ever? Download our free, detailed year-end accounting checklist PDF. It expands on these steps with more pro tips and a printable checklist. Click the link below to get your copy and start your journey to a chaos-free tax time. Download the year-end accounting checklist. Subscribe for more bookkeeping and small business tax tips. Watch next, Fiscal Year Reset, 7 financial habits to start before January. Let's make this your calmest tax season ever.